So thank you for clicking and coming to this video. I'm Tom Perrone, New England Consulting Group. And today we're going to talk about something that any advisor working with business owners should bring up as a topic. And don't get me wrong, they don't have to specialize in it. They just have to know enough about it to bring in their team of players. And the mere fact that you're going to bring it up is going to really raise your level of confidence in your business owner client. And when I'm talking about succession planning, transition, every business that starts should have an end game. And if you don't, you really don't have a business. You have a place to go, you have a paycheck, that kind of thing. But you should talk to your business clients about succession and transition. And when that should happen is really when they open a business. Start putting into play those things, which I'm going to cover today. And I'm going to use material from BEI, John Brown's group, who, if you have not worked with BEI or John Brown's group as a member, you should look into them if you're interested in business planning. They have a lot of great resources. You don't have to basically be a member, but you can be an associate member and get all the particulars of the material, which is just fantastic. Perrone's law is basically, if you design your business plan without the future of a transition to succeed, then you have a paycheck, a place to go, and a position, but you don't have a business. So I try to tell clients, let's talk the long haul. It might be 30 years from now. It might be 3 years from now. But we want to talk about what are you going to do? Because someday you're going to leave your business. And like most business owners, they put a lot of wealth in their business. You're going to want that wealth to support your financial needs. The question is, do you have a plan to get it out if you die, if you become disabled, or if you retire? So we're going to do it, and we're going to talk about a good book called Exit Planning, the Definitive Guide that John Brown wrote. He wrote a couple of other books too. And when you check him out, you'll see that he's got some great material. And we're going to be using a piece of information today that I call the Guide to Succession Planning that the Boomer Consultant firm sent to me. And there was some really good things in it. And I want to talk about those 7 steps to succession. So we're going to talk about those 7 steps, and I'm going to cover them in a way that you'll understand them, but you'll have to do your own research. But my point being that if you're in the business market, it's going to pay for you to understand what succession is all about, and that in many cases, it's very much needed as a business owner conversation. Well, here we are. Like I said, we're going to go through the 7 steps of succession plan. And again, it's to get you ready to have this conversation with your business owner client or contact. And the first thing I want to again say thank you to John Brown, BEI, and their organization. Check them out. They're fantastic. Very good organization. We get a lot out of their organization. I'm also using some information from Boomer Consulting, which is part, I guess they work with BEI. I don't know, but this is a real nice piece. And people that work with me, I give them this piece to work with it. It's very good. There's a lot in here that I'm using today. I'm not that smart to know it all, but this is a great guide. Now, we're going to talk about 7 steps: succession objectives, placing a value on the firm, increasing the value if possible over time, selling to a third party, and transferring the practice to others. That could be middle management. It could be family. And as you get older in the business, that's the point. The point is, as the business owner gets more into the business, his family gets older, the middle management starts to mature. And we want to develop a contingency plan in case the what ifs and plans don't work. And then we want to talk about estate planning, because no matter how you tie business planning, it's tied to business and estate planning. What makes me want to do this, a couple of things. I have a passion for it, but when I look at these statistics that I got from the principal group of people that are own businesses, don't have buy and sell agreements, they're not funded, they haven't done much work, it tells me there's going to be chaos at some point. And I actually, in my book, talk about the chaos that I went through in my family when my father died owning a business, and it was sold for pennies on the dollars, a very successful business, and the havoc it ran with my family. So let's talk about setting succession objectives. The first one, that's a key thing. This is the hard one. It seems easy, and it's the most essential. But basically, it's really determining the length of the time you want your firm to be the owner of your firm and work in it before you retire. How much money you need to get out of it. That's a key thing. So we're looking at the end result in the beginning and determining who you're going to transfer. Now, you don't know those answers right now, but as time goes on as a business owner, it's an idea of being aware that we need to know these things. Valuing the practice, obviously putting a number on it. Now, I've heard people say, well, our association says it's 5 times earning. Our accountant says, well, you can put this figure on it. Well, you know what? That doesn't work for me. That's a rule of thumb. There's nothing there that's logical to me. What's logical to me is coming up with a business appraisal firm to do at least a cursory look at the company based on logic, math, and all the things they need to evaluate a company. And you can find them in independent CPA firms. Some financial advisors have this software. That doesn't make them a valuation expert, but they have maybe home office people that do this for them. I have my own team, and these are individual professionals. So when someone wants to know this, I can bring them in and they can work with it. I don't have to know this, but I need to know when to bring my team in. And you could do the same thing. But what is this company worth? You want to know that periodically. And you have to know it at different times when you're doing things like buy and sell. And remember, 90%, almost 90% of the firm's assets are tied up in this person's ownership. And I always say that business owners have too much wealth in their business, and they have to find a way of getting it out. You're going to die, you're going to become disabled, you're going to retire, something's going to happen, and you're going to need the value of your practice to sustain a financial life. Okay, making your practice more value. These are things that I like to talk about all the time. They're value drivers. There's 8 to 10 of them, and I have our clients on review yearly look at them. And we talk at the end of the year, make sure they're using some of the valuable tools that are available that the advisors that you're working with can help suggest. Fiscal year end and financial audits, see what's the cash flow like, looking at what we call the lowest defensible value of your company, because that may come into play to avoid a lot of capital gains down the road. So making your practice more valuable is not only increasing the value through operations, it's making it more valuable by upping your multiples of what it's worth by having good financials, value drivers, having protection, having good management, those type of things. And you can see in here, income tax status, business consideration. These are all annual planning devices. Very important. I call it working on your business, not just in it. Okay, number 4, sale to a third party. Well, there's where the money is. That's the outside party. Some person wants to come in, they want to buy your business. That's great. Small companies, about 5% go to the outside world. Most of the time, well, in this particular area, it's controlled because it's a process with people, pre-sales, marketing, establishing ground rules, documentation, and closing. There's phase one is of a controlled process, consists of the following steps you can see. Realize the price is negotiable, understand the buyer and the seller motives, analyze historical. These are all the things that an outside buyer wants to know because they're new to your company versus the inside person. But in small businesses, I would say 5% go to the outside, get the price. However, on 95% of the time, we're talking about transfers to co-owners, employees, family. The problem there is the money. They usually don't have the money. So cash flow becomes critical in the planning. That cash flow is consistent. It's going to be there. And also the structure of the buyout with your key people, which I'll show you in a moment, is you want to avoid a double tax on the cash flow going from the company to the buyer to the seller. Very important. And so you want to also minimize ownership value of the practice, and we call this the lowest defensible value. I'll give you an example. Here you have a buyer who wants to buy the business for $1 million. Well, that buyer needs a cash flow of $1.7 million. He's got to pay income tax on that money. He nets the $1 million, which he then buys the practice for $1 million. But now the seller has got to pay capital gain tax of $200,000. So the net to the seller is $800,000 versus if we got the lowest defensible value, let's call it $300,000 for the value. The buyer only needs $450,000 of cash flow, pays the tax, has $300,000 left over to buy, to give to the seller. The seller pays a capital gain of $60,000, and that's $240,000. However, the seller receives an agreement for an income stream of $835,000 after tax $550,000. Well, the bottom line is there's $415,000 in this transaction that was saved. That's a lot of cash flow. This could be a person selling to their middle management. It could be a person selling to their kids. I throw it out there to give you an idea of some of the things that we look at. So develop a contingency plan for the practice. Yes, that's important. The contingency plan is if you're a sole owner and a multiple owner of practices, you face some challenges. The continuity of the practice, the loss of financial resources, the loss of key talent, which is you. You're there for a reason. And the loss of employees and clients. If you die, are your key people going to stay when there's no agreement or no transaction plan? They want to work. They want the job. They don't want to lose it. So again, you got to secure things in writing, communicate it, and fund it with insurances. If you're going to die, let's make sure there's insurance in place and capital to buy your family out, and the stock is not in debt form. You want your key people to know that they're wanted to be there. So you could put in place certain things to make sure that if they stay, there's benefits for them. The multi-owner practices meet the challenge. Everything has to really be up to date because death, disability, a transfer to a third party, a termination, a divorce, a retirement, involuntary, these are triggers that cause stock or a partnership interest to be sold. And you've got to be prepared for that. You can't have a buy and sell agreement that's not executed and funded, and the discussion of how it's going to be paid for. Just can't do it. These are important factors for the continuity of the company. Step 7, develop an estate plan for the firm. That's so important because no matter how you look at it, a firm estate plan is a firm's owner's estate plan is all about not just the business, it's everything else that they own plus their family. And it needs to be designed to work with a business plan. The succession planning process forces the business owner to start really thinking about what they're doing. So again, I want to thank people at B&I. They gave me a lot of information, and I do have this piece of material available for those people that give me a call and want to talk about a particular case or how I can help them. But feel free. I work with a lot of agents around the country in the business insurance, business planning market. So that's it, and thanks for taking some time. Well, there you go. I covered a lot in the business succession situation using 7 steps, but there's a lot more to it. But it may get you involved with learning more about it. And, the idea is that to bring this conversation up to your business owner client is not about you doing this. You're going to put a team together. But the fact that you as an advisor brought this up rather than someone else is a very important thing. Now, listen, some of you have been in the business and you would like to do more business planning. I find that many of you need a mentor, someone to work with. I'm more than happy to talk to you about business cases. That's what I work on. I help a lot of agents around the country with my advice. And if you're interested in getting a copy of my book called Unlocking Your Business DNA, you can get it on Amazon. You can get a paperback, and you can get an ebook. And any of the profits go to, any and all, I might say, go to some kind of wounded warrior or veteran group. So I want to thank you for taking the time. If you have any questions, you can reach me at 203-530-6615 or email me at tperrone@icloud.com. And I want to thank you for taking the time to learn about business succession. John Brown, BEI, thank you very much for wonderful information.